Welcome to Platts Commodity Pulse. I'm Dave Ernsberger, Global Editorial Oil Director at Platts. The oil markets have been through quite a shock in the last few months, but in the last few weeks have had some time to reflect on the meaning of lower oil prices and what could happen to supply in this new lower price environment that we're in today. Many big questions to ask and serious issues facing the industry. Joining us today to talk about this is Ross McCracken, Managing Editor for Energy Economist. And Ross, before we get going, let me congratulate you on 400 editions of the magazine and 33 years of production, not all personally, of course.
Thank you very much.
A great achievement for a fine magazine. So Ross, what are we seeing now in the global oil markets? As oil has been treading water in the last few weeks around $50 a barrel, and maybe some of the major oil companies have started to report their financial results that for the first time really are starting to account for that lower value. What are we seeing in terms of the economics of supply that might give us a clue as to really how supply may be responding to this price environment in the weeks and months to come?
Well, we've certainly seen some alarming headlines over the last couple of weeks. We've seen BP cutting jobs in Aberdeen. We've seen the oil services companies cutting back, and the majors are really starting to announce that their capex, their capital expenditure for next year, is really going to be clawed back. But it's important to understand, when this will actually have an impact on supply. Because at the moment, the conventional oil industry has a very sort of long lead times for its projects. So the cuts we're hearing about now really aren't going to impact the market till maybe 3 or 5 years' time. Production today is still going very strong because there's such a strong lagged cyclical dimension to conventional oil production.
I mean, famously, the mantra of the oil market has been that demand is inelastic, but it looks like, actually, to your point, supply has been relatively inelastic. I mean, we're 6 months into a price fall, and we haven't seen major cutbacks. But where would you highlight, Ross, have been some of the key areas where maybe oil production has started to be pulled back?
Initially, I mean, I don't think we're going to see those cuts. I mean, there was an interesting study by Wood Mackenzie which said that at $50 oil, only 190,000 barrels a day of world production is actually cash negative. And the element that dominates production, current production, has nothing to do with capital costs. Because if you've put that rig in, if you put the pipes in, you've drilled the wells, that capital is effectively gone. What you're now concerned about is operational costs. So even at $50, most oil production is still cash positive. Even at $40, according to Wood Mackenzie, you would see maybe 1.5 million barrels per day cash negative. But even then, just because you're cash negative, that doesn't necessarily follow that you're going to stop producing.
It's an interesting thing about the economics of the oil market. I think what I'm hearing you saying there is that the upfront costs are quite high, but once you've sunk in those costs, you're generally going to want to keep producing, even if you may be a little cash negative for periods of time. We're looking at the international rig count here, and now, are we seeing perhaps the beginning of a tail off of the rigs in operation? I mean, you mentioned it at sort of $50 a barrel, what, 120,000 barrels or so, whatever that number was of production is cash negative. Are we starting to see that bite a little bit in the international rig count numbers here? These numbers show us, I think, how many rigs are in operation at any moment in time. What are we seeing here?
This is the international rig count from Baker Hughes. It's actually defined as everything outside of North America. And we can see right at the end here, 2014, after pretty much more than 10 years of what has been a boom, not just in oil drilling, but in rig construction as well. We're beginning to see a plateau and perhaps a bit of a decline. And if you look at the press releases this month from the rig contractors, they are now cold stacking rigs. That means they're putting the rig sort of in a shipyard, they're releasing the crew, they're not going to market those rigs. The number of cold stack rigs is rising quite quickly. But again, this isn't really about today's production. This is exploration. So you're talking 4-5 years down the line when this will really have an impact on supply.
So a lot of the rigs we're seeing coming out of the market in data like this aren't necessarily productive today's oil type rigs. They're E&P, they're upstream, they're drilling holes. They may or may not find something, I guess is what you're saying there.
That's right.
Well, perhaps we could turn a little bit to look at the capex costs. I think we have a chart here that shows us a little bit around what the index looks like for people's costs and how those costs have changed through the years. I think this, we look at the report that you've done, Energy Economist, around production, and we look at some of the data you're looking at there, and I think this kind of information tells us a lot about the underlying economics of continuing to explore and produce. So what does this sort of information tell us here about the likely profitability of continuing to produce oil at these levels?
Well, essentially, this capital cost index shows you the cost of investing in upstream projects. And as you can see, a massive period of inflation here between 2004 and 2009. And then it continued to go up. Whereas we come into these last years, the oil price up till July last year was pretty much stable. It was high, maybe around sort of $105 to $110. But the appreciation in costs meant that the oil companies had effectively ceded value to the service contractors. Now, as the price comes down, that hits the producers' margins hard. They are going to turn around and they're going to say to the service companies, you have to reduce costs.
Yeah.
And as we can see from this graph and the inflation in it, there is quite a lot of elasticity there.
Yeah.
So what we can expect inside the oil industry is a period of a sort of deflation, internal deflation, where we're going to lose jobs, service contractors are going to have to cut their costs.
Maybe some wages might start coming down, or the cost of deploying some technology may come down a little bit as it's more available.
Yeah.
Is this showing us that with the year 2000 as a baseline of 100, that costs more than doubled between 2000 and 2008? Is that really what this chart is showing us?
That's exactly what it's showing you, yeah.
So we can see that capital costs did come down during the financial crisis, but then crept back up again, much like the price of oil really, soon after the crisis was over. But it seems to be hovering at around 230% of the costs of about 15 years ago. So still quite a bit of inflation in there. How much of that was related to other commodity prices? Because people were talking about steel being very expensive at one point. It was difficult to get hold of the semi-finished materials to make the machinery. Is that still a factor here, or have other markets also begun to ease up a little bit? And are we seeing maybe the kinds of lower prices in other commodity markets that could help these overall costs come down, as well as other deflationary factors? Is that something that's going on here?
Yeah, I mean, that's a very good point. I mean, the rig market is a good example because we had a massive cost inflation there, and we had a huge boom in construction. So there are hundreds more offshore rigs simply in operation. And that's had its own investment cycle. So you've actually got too many rigs. Now you've had a decline in price. Those rig rates are falling. So to give you an example, a high specification drill ship, say a year ago, may have commanded $600,000 a day to hire. That could come down to, when I first started looking at rig markets, it could be down at $230,000. There's a lot of margin in there.
Interesting. So a lot of potential swing in just those day rate costs, it sounds like, and the cost of leasing things.
And that will effectively reduce the capital cost of new projects. I mean, we're looking at, say Norway, where you have a very high cost environment. You're thinking, well, you can't do that unless it's $90 a barrel or $100 a barrel. That should shrink, which should come down to maybe 60, 70.
Yeah. Now, you mentioned the high cost environments, and we're thinking here about capital costs and what that may tell us. People have been a little wary of talking about which producing regions could really be for lack of a better phrase, the first to fold here. I was interested to see, we were reporting Shell's results through the week, and they were really one of the first majors to come out and talk about how, I mean, there have been others too, but Shell was quite high profile this week, talk about how these prices are affecting their investment plans. And they called out, I was interested to see from Ben Van Beurden's comments, they're deferring projects in the Gulf of Mexico, offshore China, and Malaysia. Those are three locations there that are being discussed a little bit. We've also heard quite a bit of talk about the North Sea and whether the UK needs to adjust its tax regime to try and reduce the burden on people exploring in the North Sea. Are those the kinds of regions that are really going to feel the pain of this more than tight oil, more than unconventional oil? I mean, are we really talking about offshore China, Gulf of Mexico, Malaysia, North Sea? Are those the sorts of areas where you are hearing the pressure coming to bear?
Yeah, I think you just have to look at the high cost environments, and they'll be the first ones to be impacted. Again, not necessarily in current production, but in terms of exploration activity and therefore future production.
So I guess your point there is we might see those regions not see as much exploration going on, but again, production may not change for a while, right?
Yeah, absolutely, yeah.
Okay, well, let's talk about the U.S. rig count. I mean, we talked about the global rig count. Let's jump to the U.S. here. As you mentioned, the global count was everything except North America. I guess here we're looking at the rig count inside the United States, but not with Canada or Mexico. Is that fair to say?
That is, yeah.
So what is the trend here? I think this has captured a few headlines in recent weeks. It looks like the oil rig count is coming down in the U.S. That seems to be what the chart is showing us here. How do you interpret this graph, and what does this mean about the pressure on U.S. producers?
Yeah, well, as you said, in the international one, we had a kind of plateau, not too much movement. Here you can see it coming off a cliff almost. It's a really sharp downturn, and that is, indicative of the situation in the shale industry. It seems to be responding much quicker. It has a greater ability to adjust than the conventional industry.
It seems like as January is coming to a close, we've gone from a peak of around 1,600 rigs or so, or maybe 1,550, whatever that number is there, down to more like 1,450 or so. Just eyeballing the numbers here. So a rapid fall in the rig count. Is this the same situation where a fall in the rig count in the order of 5-10%, maybe 15%, is only affecting exploration, or is this affecting production?
This will affect production, because these are rigs. In the US, it's only about 3% of US oil is offshore oil production. Internationally, it's about 25%. And offshore, you have the long lead times and the big projects that take years to put into practice. So what you're really seeing here is a land rig count. This is about rigs onshore in the US, and they're drilling shale wells in, say, 10 to 12 days can be the quickest you can drill a shale well.
That's a pretty fast turnaround.
Yeah, and contrast that to drilling a well in the North Sea. Yeah. So you can stop drilling fairly quickly. So that's what you're seeing.
So now, if we see this many rigs come out of oil production, they don't appear to be going into gas production. If we look at the blue line there, the gas rig count is still bouncing along around 300 or so. Does that mean those rigs are going into some sort of mothballing, or what's happening there?
Yeah, they're literally just going to become idle.
Yeah, and are these highly mobile rigs, or are they sort of more or less stuck where they are?
No, these rigs are very mobile. I mean, they can be deployed to different places quite quickly.
So if we see the U.S. rig count falling off a little bit of a cliff here, does that mean that the U.S. is the big loser at $50 a barrel?
I wouldn't say it's the big loser. Maybe in the first instance, it might be.
Maybe the first wave?
Yeah, well, let's look at the dynamics of it, or the decisions that a shale driller makes. Okay, what we have seen is a reduction in the rigs. Now, shale drillers, they drill a well, and then there's a sort of pause before that well is completed. It's fractured, and then it comes into production. And we're actually still seeing quite a lot of wells being drilled, but fewer and fewer wells being completed, which is quite an interesting sort of dynamic. So what they're doing is they're sort of taking the decision that they're not going to bring those wells to completion and recoup the cost of the drilling. They're going to wait. So they're effectively creating a backlog of wells in which they don't want to complete in this low price environment.
Almost like a warm pipeline of wells, that could come. These could come to market, I guess you were saying earlier, relatively quickly too, if the price recovered?
Yeah, because the nature of a shale well is that the decline curve is very sharp. Effectively, the shale driller will get the bulk of his output in the first sort of 3 months to a year, and then it declines very sharply, unlike a conventional well, which will have more of a smoother sort of decline. So their price horizon is 6 months. They're interested in the oil price in 6 months' time, whereas a conventional driller in the North Sea, he's interested in oil prices over 20 years.
And of course, you're looking at a different value in the forward curve if you're looking over a 5 or 10 year hedging period than a 6 to 12 month hedging period. So that may be a factor here too. Now, we do have monthly shale production to look at what the impact has been on the output from the rig count falling. And I guess what we're seeing here is perhaps not massive falls in production, a little bit consistent with what we've been saying so far, right? That these things are indicative and leading indicators, but they won't necessarily, even in the U.S., feed right through to production. But what does the chart show us here? What do we see?
This chart really shows an interesting story. If we look at the blue bars, this is new production from the 7 largest shale plays in the United States. It's put together in the EIA's Drilling Productivity Report. And you can see that effectively new production from those shale plays has plateaued. We're pretty much level on there in the last sort of 3 months. Then if we look at the bottom bar, the orange bars, this is the legacy declines from wells which have already been drilled. So this is effectively a loss in production because of that steep decline curve that we were talking about earlier. This is what you lose. Now, production, flat. Legacy declines, still growing. So the impact on that is the bars in the middle, where from December, January, and this is there's a projection for February, you can actually see the net gain in US shale production beginning to decline.
Is this every month we see 250 or 400,000 barrels a day of new production being offset by 300,000 barrels a day of loss every month.
Yeah.
That's remarkable. I mean, if you see that much flex in, because the overall number is relatively stable to higher, hence the gain number here.
Yep.
But I guess what we can see here is there's a lot of interplay between, as people have, I think, thought outside the U.S., the highly sort of short-term nature of some of these wells, right? It's really interesting to see. So do you think with the rig count changing as it is, perhaps we'll see a continued plateau or less of that new production, but still some of the legacy declines here? Is that what kind of where the theory is going?
Yeah, if we look at this next graph, we can really see how the legacy declines are catching up on the industry. Essentially, we're at the top of the curve there in terms of the blue one in new production. As we said from the former graph, production is pretty much plateauing. You see the curve behind it, the orange one, that will continue to rise. The legacy declines continue to rise as new production stalls. And then you will eventually get to a certain inflection point where those legacy declines are larger than the new production that's coming online. And at that point, the shale industry stops growing.
I wonder if that's the point that the OPEC producing nations are hoping will arrive sooner rather than later as they think about the effect of their policy on U.S. shale production, which appears to be the big battleground right now.
It certainly is. And OPEC need, in effect, to make non-OPEC producers make the adjustment.
Yeah.
For them to take the hit, not OPEC itself.
And I suppose this line also applies to conventional producers offshore, but it's just a much longer time frame, right? Similar sort of thing would be happening there as well.
It is, but a much longer time frame. That's the right way to conceptualize it.
Yeah,
One of the interesting things here is what happens when the oil price comes back. Because if you go forward in time in this theoretical model, you'll find that the legacy declines eventually start to get smaller and smaller because there was less drilling preceding them. And drilling will again take off. So you will actually have the capacity in the shale oil industry in the US to suddenly come back on stream very quickly. And we've talked about the conventional oil industry it's a sluggish beast. It takes time to slow down. It also takes time to speed up again.
Well, thank you all for joining us on Platts Commodity Pulse. We hope to see you at the next one, and I'd like to invite you all as well to join us if you can at the London Oil Forum on February the 9th. We'll be talking about these issues and more there too. So thank you again.